9, where we break down the day's action on the D Street. Now, Indian market snapped its 7-day winning run to end lower on the weekly FNO expiry day. Now, at close, Sensex was down about 0.17% to close just above the 20,900 mark, whereas Sensex gave away about 130 points to end marginally lower above the 69,500 sort of levels. Now, in the last 6 sessions, Nifty has rallied by over 5%. So perhaps some pullback or consolidation was not only expected but also desired by the street participants. Now, Nifty in the last 2 days has taken support around the 20,850 mark, and 20,850 mark was also where we closed on Monday. So perhaps going forward that becomes a crucial support. Now, on the upside, 20,950 to 960 sort of levels was the high point of the last 2 sessions. So perhaps going forward that becomes a critical hurdle for the market. Now, moving on to the broader markets, mid cap and the small cap indices continue to rally. Both mid cap and the small cap index scaled a new record high in today's trade. Today's price action is significant as the index, both indices were rather showing signs of exhaustion throughout the week. Now, Monday to Wednesday, both indices were seeing big intraday dips, which were, by the way, being bought in the latter half of the session. Now, today's movement is not a significant departure from that, but we should take a note of it as perhaps it indicates that today's price movement, that there is some more legs to this rally. India VIX, the fear index saw a massive dip of about 7% in today's session, over 7% in fact, and it has fallen below the 13 mark. Now, that should provide some respite to the bulls as it lowers the chance of wild swings in the days to come. But let's take this conversation further with Mr. Amit Gupta, founder at Fintrek Capital. Now, hello Amit, welcome to the show. What's your assessment of today's price action and the fact that we did not see any big movement on either side despite today being a weekly FNO expiry day? Does that indicate that bulls are still in control of this market?
Yeah, hi Suyesh, thank you for having me. So I believe, we had a pretty sharp rally, almost 1,000 points in 5 trading sessions. So some sort of a consolidation on a expiry day was anticipated. I think market should probably take a breather for a couple of days before, it makes a new move. The momentum was quite high. There was a bit of a profit booking also coming into the markets. But the momentum doesn't, can stop for a few days. But I think heading into the Christmas period, Christmas and New Year period, we should see more flows coming into the market.
All right. I mean, and in the last 6 sessions, the Nifty has rallied. The both headliners have rallied by somewhere around 5%, and now they are on the pace the pace of increase has been so quick that, choppiness or some bit of volatility was expected and is expected to take place in the next couple of sessions. But then some of these large caps, Amit, they are still a fair distance away from their 52-week high. And more importantly, banks have only started participating now. So does that position us for a big rally in the next 2-3 months?
See, I mean, the financials were ignored a lot and have been underperforming for quite some time. Even though a few of the technical parameters were there in favor, the balance sheets were cleaner, asset quality was under control, credit cost was also sort of on the upside. So I think the profit momentum has to happen in financials, and if that needs to happen, then financials has to lead. So I think that is one space which market participants are sort of overweight, I would say. And also what we have seen is in the last couple of months, a lot of positions from small cap and mid cap, because of the valuation factor, have moved into the large cap space. So I think large cap space can sort of keep on performing for some more time till at least the FIs are buying. And then we'll see, how much it takes. But I think banks like ICICI, HDFC Bank, these are sort of a blind call at this point of time on the positive side for 10-15%, just based on pure valuation. You cannot really go wrong in these names where the valuations are sort of mid-teen types. That's what I think.
And at this point in time, where would you lean towards the large caps or the broader markets? Because I mean, time and again, we have been talking about a bubble-like situation in the broader markets, but there seems to be no end to this rally.
I think the historical valuations, if you consider and then compare the small caps and the mid caps, you'll always find the market differences in the last 4 5 months. But the fact is, the kind of stocks which are rallying, these are newer themes which have come into the market, which hasn't rallied in the last 10 15 years, in fact. So whether it is defense stocks, railways, now the whole clean energy and renewables market, these stocks haven't done anything for the past 10 years. And when the cycle is just starting, one cannot really ignore them just based on the valuations. Eventually, the story is not just for 1 or 2 years; it's a decadal kind of a story. So even though at the headline number, some of these small caps and mid caps look very full in valuations, but the valuations have got richer with each passing days, especially when you are seeing the order books coming through. So I don't rule out any time and price correction on the small cap and mid cap, because that's how the market cycles works. So there could be a period of next few weeks where large caps outperform. But I think anybody who is interested in creating wealth from these decadal themes, they need to stay invested in the stocks.
All right, stay invested in the large caps, in the mid and the small cap stocks for decadal wealth generation. Now, moving on to individual stocks, one stock that was in the limelight today, not for the good reasons, was 197 Communications. Now, it's the parent company of Paytm, and that share particularly dropped by as much as 20% to hit a lower circuit today after the company announced plans to slow down its small ticket postpaid loans. Now the company has also said that this shift will not impact revenue and margins much, but we are seeing a big decline in the stock price today. So my question to you, Amit, is this sort of a price action justified?
Right. I think it has more to do with the RBI directive on the risk weights increase on the lower ticket item loan. So that has impacted sort of 5% revenue in this quarter, that is estimated, and for the lending revenue, and close to 15-16% impact on their loan distribution, which they do on a quarter-on-quarter basis. Now they have said that they'll focusing on the higher ticket loans, which are in the 3 to 6 lakh, 7 lakh kind of a bracket. So what you'll see the loan book getting shifted. So in the Q3 and Q4 numbers will definitely start getting impacted, because the lower ticket size the loans will reduce substantially, and the higher ticket loans within the personal loan segment and the merchant loan portfolio, that will increase. So I think it's a temporary 3 to 6 month kind of an impact, which kind of slows down the growth by almost 3-4% on a yearly basis. So I think anybody who's invested, it does not really disturb the overall thesis, but there will be a temporary blip, and given a little bit of tentativeness which we have seen in the stock over the last few months, some of the big investors have exited the stocks, whether it is Berkshire Hathaway or Ant Financial.
Right.
So my sense is, there was a little bit of a panic exit by a few players in the stocks. So, but yeah, definitely, I think 3-4 months pain will be there.
And Amit, what do you think of some of these new age tech stocks? We just had the graphic on the screen. Phenomenal numbers, phenomenal returns that they have given in 2023. Can anyone take fresh positions in them at this point in time?
So I think the number, the stocks which you're flashing, I am sort of not very keen to invest into these new age kind of stocks, because the valuations are still expensive. They've done well from a pocket, but that is mainly to do with the fact that even the US tech stocks have done well. Except I think Zomato, which seems to be a duopoly kind of a situation, and where things have accelerated on the revenue sides, and the path to profitability is a little clear. I will not be very keen on any of the other stocks. Also remember, the US, given that the rate hike cycle has ended, but the rates will remain higher for longer. I think the growth slowdown will start reflecting now in the US. And that would also mean that the funding which these companies are getting, that will also slow down. So we have to see, how they do it over the next 6 months. But something like a Zomato, can be part of the portfolio. Again, not a recommendation. We can hold the stock. But if there is a decline of 20-30% into the stocks, one can actually sort of have a look at creating some sort of a positions, because that is the only stock which I can see which can sustain for the next 5 years.
Now, Amit, you mentioned that, perhaps rates will stay higher for longer, but the market overall has been factoring in aggressive rate cuts by, mid 2024 by, somewhere some of these analysts are factoring in a 75 to 100 basis point decline. What's your opinion, sir? Do you expect or do you foresee these type of aggressive cuts, or, rates will remain elevated for longer?
So, I mean, the Fed Fund future is anticipating 4 to 5 rate cuts next year. But these are very dynamic things. If the GDP growth stays where it is for US, let's say around 5.5%, if there are not too many job losses, then one can expect a soft landing, and in that case, you'll see higher for longer, and then rate cuts, sort of get pushed. Remember, at the middle of this year itself, in June, we were anticipating a rate cut by the end of the year, which again got pushed by 6 months. So these are very dynamic things. They keep on changing with every data point which is coming from the US, and globally, whatever is coming in the form of data and results and earnings.
All right.
So I will not jump the gun on the rate cuts. We are definitely, looks like that there will be no further rate hikes. But whether rate cuts happen in June or before that, that is a matter of sort of, argument, and we have to see how the data evolves.
All right. Now, another stock that was in focus today was SpiceJet. The stock was in fact logged in a 20% upper circuit after the company said that it is considering options to raise fresh capital. In the last 6 months, I mean, the stock has surged almost 90%. And this, in fact, very interestingly comes at a time when FIIs and promoters have been, trimming their stake. So, for retail investors, for us, should we use these sort of rallies that we are seeing to exit the stock, or is it a pivot as far as operations go?
No, firstly, as a disclosure, we don't own the stock. We have recommended. But what has happened is that in July, the SpiceJet promoter Ajay Singh that infused almost 500 crores of his personal money by subscribing to the equity share. So that sort of started the rally, because if the promoter is infusing the money, then a good things can be expected from the company in terms of operations. But despite that, the SpiceJet fleet that has been partially grounded, and the airline has been looking for various ways to raise more capital. In fact, three craft lessors, they have sort of filed insolvency clears against SpiceJet in the NCLT, and those cases are also going on. So I think their prime, objective at this point of time is to sort of do this fundraise and try and raise some money for the operations, and paying out the debt from their books. They haven't released the Q2 results also till that. So I think in the board meeting they are also going to do that. It appears to be sort of undervalued when compared to the other peers like Indigo. So a very substantial equity infusion can actually turn around turn around the story for that. But it's a bit of a catch 11 situation because if the fundraise is not done or it's not sufficient enough, then you'll have a lot of problem in terms of financial operations.
All
So
right.
it's a sort of a wait and watch kind of a situation.
All right. Wait and watch as far as SpiceJet goes. That's the view coming in from Amit Gupta. Sir, always a pleasure speaking to you. Thank you for joining us here on Last Check.
Thank you, sir. Thank you for having me.
But with that, we have completely run out of time on this edition of Last Check. Keep watching News 9.